All right, so welcome back to Lunch of the Market, and today we have nothing for you. Seriously, I mean, other than bragging about how much money we've made this month, and how weird my assistant's, ultrasound pictures are. She thinks they're cute, but I just think it's weird that you like put a device up to somebody's uterus and then you see what's inside. I mean, does that sound creepy to you? Because it sounds creepy to me. But we're glad to have her back. She was out with the flu, and it was a total nightmare while she was gone, which is why Lunch of the Market was late most days. Yeah, there's not a whole lot going on. I mean, if you're short, you're getting your face ripped off. If you're long, you should be pretty happy. And if you sold put spreads, then Christmas is coming up soon. So we'll see if volatility holds. Okay, so that is one thing that you could do today is VIX, right? It's really important on days like today to be hedging. I mean, it feels terrible. Who likes to waste money on hedges? But the reality is that the higher the market goes, the more the risk is to the downside, right? So what we'd be looking at is a trade that we actually did today. We put on the May 1721 call spreads in the VIX. If you're trading on Trade Monster, all you have to do is type in VIX. You can actually buy calls, buy options, right? Sell options right on the VIX itself. Remember, the VIX is the volatility index. The VIX measures the volatility of the S&P 500, and the VXN, the VIXN, measures the volatility on the NASDAQ, right? So you probably get more bang for your buck on the NASDAQ VIX, but we like the S&P because, the S&P is a good proxy for the overall health of the market. So we like May. Why do we like May? Well, there's a saying, sell in May and go away. And it's really important to keep things like that in mind because all of us know that, right? So everybody out there in professional money land is aware that at some point between late March and May, we have to sell everything, right? So there should be some volatility, especially if we see a prolonged sell-off like we did last year from April 20th down to the July lows. I mean, the entire month of May was terrible. June was pretty bad, and then the lows came in July. So, I mean, that's a pretty long period of prolonged selling. Our target on the S&P, the low end of our target is 1308, and we're pretty much there. And then the high end of the target is 1365. It doesn't take a lot to get to 1365. If you take 15.17 PE, multiply it by $90 in earnings, that gets you to, I think, 1365. It's just not bad. I mean, a 15 PE is not stretched by any imagination whatsoever, and $90 in earnings is actually really on the low side of the estimate. So somebody accused us of sandbagging, and I just said, hey, we're just trying to be like Apple, right? That's our hero, because we've made tons of money in Apple this year, and they always sandbag, right? Guidance. They always lower the bar as far as they can with still be kind of realistic. So those are our numbers for the year. We're already at our low end of the guidance, so of course it makes sense to put on hedges. If you don't, then you buy insurance before the house burns down. Once you catch it on fire, you can't call the agent and ask for insurance because they won't give it to you. In the markets, if you try to buy insurance while the house is on fire, you will pay an exorbitant amount of money, and is almost, unless a cataclysmic event happens, you're not going to profit from your hedges. So go ahead and take a look at buying the May 1721 call spread in the VIX, right? You can do it easily through Trade Monster. Just type in VIX and click the options button, and it'll pull up the options chain for you. We like May because it captures that sell in May event, and whether the event happens in very late March, anytime in April, or in May, you're covered, right? All of those time frames are covered. Summer's historically a rough time to be in the market, so just make sure you go into that period of the year either really nicely hedged or big cash position or both. We will be hesitant to continue to add positions after February options expiration because the markets are probably registering overbought on quite a few oscillators. So we just want to enter with caution. Things have gone extremely well. We were just taking a look at chart at SourceFire, a chart of SourceFire today. That's a position that we have both long stock and short calls in. So far, it's holding that $25 level, which is where a percentage of our short put spreads are. The place to get in, and it's a great line, is 22.69, around 22.69. That line goes all the way back out a year, and it acted as support in February, March, April of 2010. The stock broke below that and it acted as resistance for May, June, July, August. September, it broke above that line and then came back down to test. The stock traded all the way up to $32 and change, gap down $10, went back to test that 22.69, bounced extremely hard off that level, tested it for a second time, bounced off that level, tested it a third time in January, and then a fourth time in January. That 22.69 level is a fantastic level to shoot against for FIRE, that's source fire. Again, we do like being long that stock. We're long the stock and short the put spreads against it. The next line of resistance, it's crossed above one line of resistance was 25.10. We're above that level. If it holds, the next line of resistance isn't until 28. So that's about a 10% move from here. So you know there's certainly, you can enter the trade now right above that 25.10 level. You could always set a limit order if you want to buy source fire at 25.10, and then you should be clear up to 28. If it breaks and holds 28, the next level is 30, and then back up to what I think was probably the all-time high at above $32. Yes, that was the all-time high. So those are your levels in source fire. Please put on your hedges, buy some puts. If you've got something that you've kind of feel like you're walking the tightrope on, like, should I still be owning this? If you're up massive, 30, 40, 50, 60, 70% in some positions, spend some of those gains on hedges, right? Then you can sleep at night, and if the stock trades over, rolls over, goes down, then hit the exercise button, give your stock a farewell and wish the person luck who sold you those puts. All right, hope that's at least a little bit helpful, but really there's not a ton going on today. Our book is going extremely well. Our only issues are BVN, which I hate gold. I guess that's another thing I probably could have talked about all day today, is how much I hate gold. It's a extremely crowded trade. It's getting harder and harder to be right, I think, for either side, and it's probably going to take months to clear out of its recent range and develop a trend. So we'll see how it goes. We're short, unfortunately, lots of put spreads there, and we are long BVN and some GDXJ. That's our gold position. The only reason we have it is because we think Jim Cramer's a really smart guy, and we'll just wait and see if he's right. I know he's smart, but we'll see if he's right. You can't make every call a good one, especially when you make like 10,000 of them during the course of the year. All right, thanks for tuning in again. Watch the Packers on Sunday. If you watch sports on Sunday, we're going to be cheering them on, but we won't be watching. Thanks for tuning in again today. Have a great day, and we'll see you on Monday.